Good afternoon, and thank you everyone for joining us today for our fireside chat with Havertys. I'm Christina Fernandez, Senior Analyst at Telsey Advisory Group covering the home furnishing sector. And with me today is Clarence Smith, who's CEO of Havertys and has served in this role since 2003. Clarence is going to start with some brief prepared remarks, and then we'll proceed to the fireside chat. So Clarence, I'll hand it off to you.
Well, thank you, Christina, and thanks for having us on the TAG conference. We have been very pleased with the record performance that we've had this year. The last 4 quarters were the highest in the company's history, and the third quarter was the highest. So we've seen a dramatic return. This return to home that was initiated because of COVID, we think is important, and I think it's changed the way people think about the home and what they expect to have invested in their home. So we think that has some momentum and will continue. We also feel like we're in the right part of the country. We serve the Atlantic, Southern, and Central states, 16 states, and I think this is where most of the country wants to be. Our biggest states are Florida and Texas. So again, that's where people seem to want to move, and we're pleased to be there. So appreciate you having us on the conference, Christina.
Great, thank you, and that's a great way to start a conversation today. You talked about your geographic footprint, which I think it's a differentiator. Maybe for the viewers on the audience who are not as familiar with Havertys, tell us, kind of what is different about Havertys, what's unique about you relative to the competition and other home furnishings companies out there.
We purposefully, about 8 years ago, decided to make sure it was very clear in the marketplace that we were different from the promotional houses that we compete with. And those, in most every market we're in, we have Ashley and Rooms to Go. We focused on design. We hired designers for every store. We call it our H Design program, and emphasized special order customization, and have been really successful in that. It's in the mid 20% of our business. We get in the customer's home, and when we're in the customer's home, our average ticket doubles. So that has been a real driver of our business over the last several years. It's important, continues to be important. We've had some challenges with product in special order and that type of thing this year, and the challenge is getting our decorators in customers' homes because of COVID, but that is improving and continues to be a main driver.
Thank you. In thinking about demand, we know home furnishings has been really big beneficiary as consumers spend more time at home. As we look into 2022, I guess, how do you expect the industry and maybe Havertys to perform? Do you think this is a new level, like a step up in demand that stays here? Could, there be more growth, or could we pull back a little bit from the high demand we saw in 2020 and 2021?
Well, what we released at the end of the quarter, our written business was down slightly compared to the previous year, which was clearly accelerated following the COVID and the whole focus on the home. But I think that the boomers, millennials, and Gen Xers have decided that the home's more important. They want to have a house. They want to have a place for their children to grow up. And I think we're seeing more homes, more households being formed than in the past. And I think that's a real driver that will continue. Will it continue at the rates we saw? I don't know about that. But I do think we've reached another level. And we certainly don't expect to go backwards. We want to grow, and we're aggressive in looking for opportunities, but I don't see this thing slipping back to where it was in 19 or 18. I just think there's momentum here. We've got a big backlog of product that we're trying to fill and expect to fill all into the next, maybe second quarter of next year. So I think there's some real momentum there.
Yeah, and that all makes sense to us. I mean, you have the backlog that gives you visibility, but are there any metrics that you're looking at that give you confidence or that you could use to predict your business? I'm not sure if you look at home pricing or housing turnover or traffic? Like, I guess as an organization, what indicators are you looking for?
Well, just looking at our internal numbers, we have seen a slowdown in traffic, but our average ticket is a driver, and it continues to grow. Our closing rate is improving, so we're reaching a customer that understands what we offer and wants to react to that. So we are seeing a good trend here. So those three things we look at. Now, when at the peak of our growth about 6 months ago, we did see all three going up. And we're doing everything we can to make sure we reach the right customer, new customers, to get the traffic figure positive, because ultimately that is a main driver.
Yeah. How about promotions? And I don't know if this applies to Havertys as much, but the industry used to be more promotional back in 2019. It's pulled back, and I think everyone's benefited from that. Do you think it can stay at this level, or are your expectations that if demand slows, there could be more promotions in the marketplace, impacting everyone?
Well, we did see we didn't have to be as promotional because the traffic was strong, and we were able to be more disciplined about that. What we have done recently, and we've seen the importance of credit, so we're promoting credit a little stronger than we did last year. We're not discounting. It's mainly just offering credit opportunities for our customer, because this is a big ticket. Our average sale has gone up, our average price has gone up, our average price per SKU, it's more expensive. And so financing is important. So credit, we've seen a good reaction to, and I think we'll continue with that.
That's good. Then let's shift to supply chain, because I know demand has been great, very good, and it's been a little bit hard to fill all that demand. So how has that affected Havertys, including, maybe you can talk about order to delivery times, how long is it for customers to get orders? Are they getting better? And then I'll follow up on that.
Well, I'd say it's improving. We have a big backlog. Some categories are weaker than others. For instance, case goods, which is mostly coming out of Vietnam, bedroom and dining room, that we're at the weakest position there, and that is hurting those categories. However, we're stronger in upholstery now. We're getting better domestic deliveries, which has improved since the product components have been improved. We had backlog with steel and foam, and that's improving. They're getting more production out of our domestic suppliers, so that's a bigger percentage of our business. We are missing some sales in bedroom and dining room because we don't have the product, and that'll improve in the first quarter of next year, into the second quarter of next year. And again, I think that could be a positive for next year. But the container rates got outrageous, as you know. They got up to $28,000 a container, where in 2018 and 19 it was $3,500 a container. So that's coming down. We're seeing some improvement there, and I think that'll continue to improve. But the shutdown because of COVID in Vietnam definitely impacted us in the supply chain. It is improving. They are coming back, but it's coming back slower than we'd like. And I don't see that improving for several months. I don't think they'll be back to 100% until maybe the middle of next year.
Okay. Yeah, so on Vietnam specific, which I know, is affecting everyone on the case goods. So I guess when do you expect to start getting shipments again? And if production comes back in the spring to be 100%, I guess what's the lag till when your receipts can start normalizing?
We're getting shipments now. We just got a report this morning. We are getting shipments from Vietnam, but it's not at full production. I'd say half production. They still don't have all the work back, and it is a challenge, and it'll continue to be. Again, I think that it will be back to full production probably in the second quarter of next year. But we are getting shipments now, and the containers being released. We expect still to get this year some that were released. For instance, this week we'll get late this year, but it will affect our deliveries.
Yeah. Are you finding the consumer is willing to wait, or are order cancellations increasing, and perhaps they're looking for other products when they see such long lead times?
I think the customer is willing to wait for something they want. They know that there's going to be a delay. We are focusing on what we have in stock because our stock position is actually the best that it's been for a year and a half right now overall. It's just certain categories we're out of. So they will wait. But as it comes down to holiday time, it's not quite the priority. So they may not be willing to wait as long as they would have if, let's say, they bought in September and we set a December delivery, they would be willing to wait. Now that it's holidays, I think that's another challenge. They may just wait till next year to see what their situation is then and come back. So it's a combination.
Yeah, that makes sense. Maybe they needed the item to host friends and family, so they needed it now.
Right.
Then it seems like consumers have been willing to wait. The situation has been happening for for some time. It's just gotten worse in that specific category. But I guess that's been in some ways positive that cancellation rates have not increased. On the container costs, you mentioned that you think they're starting to come down and I guess could level off next year. How is that impacting your profitability? You think, we're going to see margin compression next year?
We've been pretty good at being able to get our margins. We've had really good discipline and increasing our prices where we had to. We've had less discounting in our store level. We have fewer markdowns, which has allowed us to maintain our margins. It is a challenge for sure. Particularly with what happened last quarter, is we had a backlog that was so large, it backed up at our distribution centers. So we were running some demurrage costs, which hit our bottom line, and just the additional freight. But that is a mix of what we have at contract level. We have contract freight and then we have spot rate, and you have a mix of it. And I think that is starting to play out and reduce the overall expenses and the overall freight cost going forward. The freight carriers are working with us to try to finalize negotiating on next year's contract. So we're doing some of that, but we're cautious because we don't think it's coming down enough for the new contract to be able to sign now. So that's something our team's constantly working on.
Yeah, and that's something that a lot of companies we speak to are debating, how much to sign on now for higher rates, for lock in a rate versus try to wait for things to come down and perhaps take a little bit more short-term pain but have a better contract rate looking out. So I'm sure you're spending a lot of time on that. I guess another area related to supply chain, there's been a lot of inflation across, not just in supply chain costs, but raw materials, labor. I guess, how much is that impacted Havertys? And have you had to pass through price increases? Do you think there'll be more next year?
Well, we have had price increases. We've passed them through. We're doing that now where it's necessary. We don't see that as a continuing thing, but it is happening now. And it has happened. And I think it'll start to level off next year. We certainly don't want to keep raising prices because it does have an effect. When you've had, and you see it for the industry, the average price increase is probably about 12 to 14%. That's a lot on big ticket items. And we're doing everything we can to hold the pricing down. But when we get increases, we do increase our prices. Yeah, no, it does tend to translate into a few $100s, which is big.
I guess what can you do, or what are you doing as an organization to offset those price increases? Are there areas where you can cut costs, or what are the mitigating factors?
It is an area that the cost increases are across the board. I mean, our personnel costs are tougher to be able to hire warehouse and drivers is a real challenge. We're having to pay more. We are holding back, though, the number of people that we have working for us. We've got 15 to 20% fewer people working at Havertys than we did all the way back to 19. Yet we're doing 25% more business. So that's how we're able to be more profitable, is to leverage our team and our infrastructure that we have in place. And I think that's what has helped us produce these record profits over the last 4 quarters.
So I wanted to move on and talk about some of the specific initiatives that you have to support growth over the next couple of years. And some of this have been in the works, pre-COVID. But perhaps let's start with the retail stores. You've been expanding into some markets. It seems like there's more. I guess, how many stores can you operate longer term?
Well, next year we had plans to open 5 stores, net of 3. A couple of them are relocations. We are looking at all of the markets within our footprint, 16 states. Maybe it could go to 17 or 18 states out of that footprint. We're looking at every single market. We think there are opportunities, and particularly since we've had success with the smaller format stores. This past year, we opened a couple of stores that were less than 30,000 square feet that are doing very well. And that opens up opportunities that we would have struggled to find in the past. We think that there are a number of markets where we could use more stores, where we already have a location, and we're looking at all of those regions. And I think that ultimately, let's say we got 121 stores now. I think we could hit 150 stores within several years within that footprint.
Yeah. Are you finding that with COVID, and there's been, definitely store closures, particularly last year, there's better real estate out there for you, better leases that could, give you better economics in some of these stores going forward?
We did renegotiate a number of leases at the time. I do think that we have to be very choosy about where we go. We think it's more of leasing versus owning and building, because I think you can get better locations. We're very good at converting existing boxes to Haverty stores. And that's how we've grown mostly. And I think that's how we will grow. Building new stores today is very expensive. We're learning we can get by with smaller stores. We're generating more sales per square foot than we ever have. And these smaller stores are working for us. And that's a very encouraging thing for us, particularly recognizing that the website and how you can reach the customer and communicate with the customer and close sales, the combination there, I think, is something that's important and allows us to grow within our footprint without opening big 100,000 square foot stores. That's not something we're looking for.
Yeah, makes sense. How about on the marketing side? I know earlier this year you rolled out a new marketing campaign. Can you talk about what you're doing there, and perhaps anything on social media, which is a big source for customers, how they look to inspire themselves to decorate their homes?
Well, we have a new marketing lady, Hill.Mr, who's a senior vice president. We brought in a new agency a little over a year ago, and EP and Company out of Greenville, South Carolina. And they've helped us understand the customer. We're reaching new customers. We focused on the digital and social media, and spent less on television, more on over the top, and recognizing that's where the customers are today. So we're trying very hard to reach a newer customer so they understand who we are and grow our business that way. We're very good with our existing customer core, but we're looking for some of these new millennial X-Gen people who understand they want better furniture and they don't know enough about us. So and we're also spending a great deal of energy right now on redoing our website. We brought in the entire, not the entire, but most of the Adobe software package, and that is being put in place. We're going to have a rollout of the new website by the second quarter, and have adapted our current site also. So we know that's how the customer comes to us. That's our front door, and we want to have the best website in the industry. And I think by next mid-year we will. And I think that's how the customer understands us, how they want to react with us. That it's more inspirational, telling her more about us. So our campaign is "We Furnish Happiness," and we've set a higher bar for what we expect our people, our team, to be able to perform, and understand that they expect a lot from us. So it's about happiness, and that's a high bar to have in front of us.
Yeah. Yeah, I follow up on that. I mean, you mentioned trying to target a new, a younger customer, I guess, who's not as familiar with the brand. I guess, what is the brand awareness out there? I guess, like for that younger customer, I guess, what is the perception? Is it just that they think they're not ready to shop at Havertys, or they're not familiar with the brand, or how do you get over that, that hump and getting them to come to the brand?
I think we've been doing it over the last several years. We've spent well over $100 million redoing our stores, making them more contemporary, more fashion oriented. We added the H designers, more decorator services, more special order, more customization. We've upgraded our product line. We've added more customization, more special order, all of that. And when the agency did a deep dive on who our customer is, the message back, let's say 4 or 5 years ago, was our number one customer was in the early 50s. Our new target is 41. We want women, family owners, families with the woman at 41 years old and over $100,000 in most of our markets. We're very focused on that target. And I think the agency and Helen leading us, along with our merchandise team, has helped us appeal to this customer. So we're in a consideration set we weren't in before. I don't think necessarily many of our customers thought of us along with Pottery Barn, Crate and Barrel, Restoration. I think we're in that consideration set now, and even Ethan Allen, because they're almost all special order, all custom. We're offering a mix, but also at I think a better value. So all of that focus has helped us reach a younger, more fashion-oriented customer.
That's good to hear. And I mean, you talked about e-commerce already, which I know is a big initiative. Any other initiatives that anyone who's listening should be aware that you're working on, that's important to the company's outlook over the next couple of years?
I think what we talked about a little earlier with the smaller format stores that use technology. We've got a lot more technology in the stores that helps the customer understand how the product's going to look in their home, 3D room planners, all of that. But dealing with our team members, our H designers, who can help the customer see their vision, and that we can help that come true. So I think that's really what's changed over the last several years. And now we know that we can do it with a smaller store. And that gives us more opportunities to be able to reach markets that we couldn't reach in the past.
Yeah, we hear that from a few, and perhaps that could give you opportunity to go into, as you said, smaller market, vacation market, things like that, where a big store doesn't make sense. We only have a couple of minutes left, but I wanted to talk about, I guess, profitability. You mentioned that you are now operating much more productively with 15 to 20% less, less staff. I guess what else? I mean, and I know freight costs. That's a on the offset that that's a pressure point. But what else should we be thinking about for 2022 as far as like puts and takes on the profit, which I know has stepped up a fair amount from pre-COVID levels?
Well, we talked about what's going to happen in the future. I think that the whole platform for home furnishings has been risen. I know that it has for us. We have no intention of going back to where we were. We're now generating double-digit profits. We didn't do that before. Every quarter of the last 4 quarters have been double-digit profits. We want to stay there. Double-digit operating profits. We think that's something we can sustain and even increase. So it is a real focus of the team to be able to get more out of our team, to leverage the organization we have, and raise our operating margins. We've been able to do that. We plan to do that going forward and continue to grow our business in the years ahead. And I think 22, 23 should be good years for us and the industry.
Yeah, that's great. That's really positive. How about lastly on capital allocation? You've been pretty active in paying dividends, even did a special dividend, doing buybacks. I guess what are the plans and also the areas of investment for the company going forward?
We've generated a lot of cash over the last several years, over 200 million on our balance sheet. So first of all, we look at CapEx, and we had about $35 million this year. We're looking about the same next year. And then after that, we look at buybacks and dividends, and we like a balance. And we've historically said we like to pay back about 50% of our earnings. And we want a mix. We want a mix of stock buybacks and dividends. So we've increased our quarterly dividend last year. It's yielding about 3%, maybe a little bit more. And we had a special dividend, which pays out next week for $2. We did the same thing last year. That's not necessarily something we would want to sustain, but if we're generating that much cash and don't see another opportunity, we have a philosophy of giving it back to shareholders.
Okay. So before we close, anything else that you would like to tell us about or that the viewers should be familiar with?
Christina, I don't think so. We've covered everything. I think we're in a good position in this industry, and I think the industry is a good place to be right now.
Great. So, well, with that, we'll conclude our event. Thank you to everyone who listened to the presentation. Thank you. I think we're the last presentation today, so thank you for participating, and stay tuned for the next share conference, which is being held Monday, December 13th, and will feature energy and industrial companies. Have a great day, everyone.
Thank you, Christina.
Thank you.